In this video, I'm going to cover different business unit performance management measures like ROI, residual income, and EVA using problems 1443 and 1444 as a demonstration. So in this problem, we have Colonial Pharmaceuticals, and it has two main divisions, AC division, SO. It mentions that AC is much smaller, and the life of its products tend to be shorter than those produced by the larger SO division. And I can look at its divisional investment or its asset base and see that extreme difference, 9,000 for AC and almost 10 times as much for SO division. So our first measure is going to be division income. And so basically that's going to be operating income. They don't ask us to calculate net income because they don't provide us the income tax information. So operating income is profit before we subtract out taxes. So I'm simply going to look for my sales for AC division, which is $8,000, and subtract out any expenses for the year. Now, you may do these in a different order. It doesn't matter. We just need to come to the same end number. This isn't a formal income statement. I first subtracted out cost of goods sold of $3,200. Next, I jumped down here and subtracted out SG&A expenses. That's selling, general, and administrative. Next, I came back up and subtracted out R&D or research and development expenses. And last and not least, I subtract out an allocated amount of corporate overhead expense of $600 for a final divisional income or operating income, again, before we subtract out income taxes of $1,500. You will note I didn't subtract out divisional investment. It's not a cost or an expense. It's the amount of our asset base. So that's not something I would subtract out. Now, next we jumped into operating margin. So there's a number of margin calculations. There's gross margin, operating margin, and also profit margin. All of them we divide something by sales, but it's just what measure on the income statement do we divide by sales. For our operating margin, we divide operating income, which is our profitability before we subtract out taxes. And again, in this problem, we're not given tax information, so that would be our $1,500 divided by our sales of 8,000. Had it been gross margin, it would have been our gross profit or sales minus only cost of goods sold divided by our sales. Had it been the profit margin, it would have been net income. So I would have had to know what the tax amount was to subtract it from division income divided by sales. Again, operating margin, operating income divided by sales. Here it's 18.75. Now, I'd have to know either historically what it's been for AC division or what SO division is to compare that and understand is this good or bad. I'm only in this video going to do AC division. I'm going to allow you to do SO on your own and make that comparison. Now, perhaps a new measure for you is ROI or return on investment introduced in this particular chapter. Now, it is similar to operating margin in that we have the same numerator, the $1,500. In fact, really, we should have had net income in this one, but again, we're not provided the tax information, so operating income or division income is going to have to do. Instead of dividing it by sales like I do for operating margin and getting a more of a measure of what's my cost control, overall profitability related to my sales. Instead of that, I'm going to divide it by my asset base or divisional investment of $9,000. So what I'm trying to do here is, look at, relative to the assets that I have, how much profitability am I actually earning from them? For this company, it's 16.67. Now our next measure, D, is going to be residual income. So it has the same components as ROI plus one additional. I just rearrange it. So instead of dividing our divisional income by our divisional investment like I did here, I'm first going to take our divisional income of $1,500 and I'm going to subtract from that. This is what I actually earned, the $1,500. I'm going to subtract from that what I anticipated a minimum that I should have earned for my divisional investment or my assets. So I'm going to take that $9,000 of divisional investment and multiply it times the cost of capital or minimum required rate of return, minimally what I should be earning, which in this problem is going to be 9%. So 9% times 9,000 says here's minimum what I should have earned. Subtract it from the $1,500 of what I actually earned, and I have additional earnings relative to my minimum of $690. Now, just as a hint, I should have known that this was going to be a positive number because my actual earning of 16.67% is greater than my minimum of 9%. That tells me it should be positive. If C ROI had been 9%, and again, my cost of capital or minimum is 9%, residual income would have been 0. If C had been, let's say, 6%, something less than 9%, then residual income would have been negative. It would have said I'm not earning at least the minimum of what I'm required to earn. In this video, I'm also going to quickly cover another measure, EVA. Now, EVA is very similar to residual income in that we look at earnings relative to our minimum. It's just the argument for EVA is that there's some accounting conventions that they don't feel like necessarily correlate to reality. So they want to make some adjustments to those. And one adjustment in particular is when we're expensing research and development. So for accounting conventions, it's typically go ahead and expense it all right away. For economic value added, the argument is no, I actually should capitalize some of that front and more slowly expense it over time. So we need to make adjustments for that. In fact, they tell us that R&D is assumed to have a 2-year life in AC and a 9-year life in SO. And again, if we're using normal accounting conventions, all of the R&D was expensed right away like we saw in our divisional income. So I need to make 2 adjustments for EVA. First, I need to look at my prior income measurement, divisional income, again, based upon my typical accounting GAAP adjustments, which was $1,500. And I need to acknowledge that while in here, I had expensed all $2,000 of the R&D. Again, EVA makes the argument, I should have actually capitalized that and more slowly amortized it over time. Again, R&D for AC division is a 2-year life. So here you can say, I'm saying, you know what, I need to add back 50% of that $2,000 or $1,000 because I should have split that into 2 years. I should have expensed $1,000, which is already out of that $1,500 in year 1, and I should have saved the additional $1,000 to expense the next year. So my adjusted profit is $2,500. Also, don't forget you need to make an adjustment to divisional investment because keep in mind, we're going to initially capitalize part of the R&D and then expense it in future periods. Our divisional investment, according to accounting conventions, is again $9,000. But let's add back the portion of R&D that we're going to save to expense in future periods. That's the other 50% or $1,000. So our adjusted investment is $10,000. Now, once I make those adjustments, again, the flow of the calculation is very similar to residual income. I'm going to take my adjusted profit of $2,500 and from that subtract what I minimally should have been required to earn. My same 9% cost of capital, again, times my adjusted investment of $10,000. And so here I have 9% times 10,000 would have been $900 minus the $2,500. I have an adjusted EVA of 1,600. Again, I'll have you tackle SO division on your own in order to do a comparison between the divisions. One quick thing that I do want to mention, because I tend to find some issues with the SO division calculation for EVA. It's a little bit tougher one. If you recall, it mentions that there's a 9-year R&D life for SO division. So what you want to do is you'd want to take the initial accounting profit and add back 8/9 of the R&D, which is 8/9 of the $3,600, because you're saying, hey, I only should have expensed 1/9 of that in the first year. 8/9 of it should be saved. Similar for the adjusted investment, I'd take my divisional investment of $80,000 and again add back 8/9 of that because again only 1/9 of that R&D should have been expensed in the first year. 8/9 of it are going to be saved to future periods and more slowly allocated over those additional years.